Welcome back to another episode of MBA's Teach Econ. Today's lesson is on the Federal Reserve, or the Central Bank of the United States. The Federal Reserve has two main goals: control inflation and maximize employment. Before we go into how the Fed accomplishes these goals, let's think a little about the structure of the Federal Reserve System. You can think of the Fed as managing a large basket of reserves. And within this basket are all of the non-vault bank reserves for each of the banks in the U.S. banking system. So we might have USAA, Bank of America, etc. This central repository for reserves results in the creation of the federal funds market. The federal funds market is basically the credit market for banks. On our y-axis, we have the federal funds rate in percent terms, or the rate at which banks lend and borrow from each other. On the x-axis, we have quantity of reserves in the federal funds market. The demand curve consists of each bank's desired amount of reserves at each federal funds rate. When the federal funds rate is higher, banks demand less. When it is lower, banks demand more. Much the same as if you were taking a loan out for yourself. You are much more eager to take the loan when the interest rate is low. Banks behave in the same manner. The supply of reserves is controlled completely by the Fed, as they are the only entity in the U.S. who can create or destroy reserves. The Fed accomplishes its two main objectives: maximizing employment and controlling inflation through its manipulation of the federal funds rate. Under expansionary monetary policy, the Fed would target a lower federal funds rate. Under contractionary monetary policy, the Federal Reserve would target a higher federal funds rate, thereby influencing banks to lend more or less as the situation dictates. The Fed exerts this influence through three main levers. First, the Fed sets the overall level of reserves that a bank must maintain, also known as the reserve requirement. Under expansionary monetary policy, the Federal Reserve would lower the reserve requirement, thereby decreasing the demand for reserves. And under contractionary policy, the Federal Reserve would increase the reserve requirement, thereby increasing the demand for reserves. Second, the Federal Reserve can change the interest rate that it pays on the reserves held in this central repository. Under expansionary policy, they would decrease the interest rate, thereby decreasing the demand for reserves. And under contractionary policy, they would increase the interest rate, thereby increasing the demand for reserves. Finally, the Fed can use open market operations to increase or decrease the overall level of reserves in the federal funds market. Under expansionary monetary policy, the Fed would buy bonds from banks, thereby increasing the supply of reserves. And under contractionary monetary policy, the Federal Reserve would sell bonds to banks, thereby decreasing the overall level of reserves in the federal funds market. The Fed's influence on the federal funds rate through these three main levers is how the Fed conducts both expansionary and contractionary monetary policy and achieves its two goals of controlling inflation and maximizing employment. Thanks for listening, and see you again soon.